Hi everyone, I hope you're keeping well. My name is Janet Lavuna. I'm the Tax Controversy and Dispute Resolution Lead at PwC. Under the subjects tax fraud and tax evasion, we're going to look at how these terms are defined within the laws, how and why they crop up in tax assessments, and how the interpretation that is applied to them can affect a taxpayer's assessment. The reason why this subject is important for discussion is because it's an emerging issue and also because it's very punitive when a taxpayer is accused of fraud in an assessment and tax evasion, because in the end, under this current economic environment, a taxpayer ought to be able to avoid as much as possible being accused of fraud or tax evasion. The reason why disputes arise out of this subject is because sometimes a taxpayer, because of mistake or neglect or a misinterpretation of the law or their own understanding of the interpretation of certain provisions, may act in a certain way, and this KRA may, on the other hand, interpret to be tax fraud and tax evasion, and therefore the taxpayer then has to challenge KRA's assessment on that ground. The wording within the definition of the terms fraud and tax evasion begin with the words where the commissioner has reasonable cause to believe or where the commissioner has the opinion, and also they expressly state that where the taxpayer knowingly does this or that other thing, then it is fraud. And this is an area of dispute because what the commissioner believes to be reasonable may not be what the taxpayer believes to be reasonable. And also the fact that the terms knowingly are used means that the taxpayer ought to have a motive.
My name is Jerop Kigen, an associate in the Tax Controversy and Dispute Resolution team in PwC Kenya. I will be talking about the definition of tax fraud as per our tax laws and the consequences of a taxpayer being found guilty of tax fraud. In Kenya, tax fraud is a criminal offense that can take several different forms. The Tax Procedures Act provides instances when a taxpayer can be deemed to have committed tax fraud. This occurs when a business entity or an individual either knowingly, 1, forges their books of accounts, for example, under-reporting income or not even reporting any income, 2, falsely claiming tax reliefs or refunds. Additionally, omitting any amount that ought to be in a tax return constitutes tax fraud. Some commentators have taken the position that this legal provision on tax fraud can be especially problematic for a taxpayer, as it can give room to tax authorities to interpret and impute tax fraud on a taxpayer even when a taxpayer's actions do not constitute the legal threshold of tax fraud. For example, where a taxpayer makes a mistake. Our tax laws are numerous and can be complex to navigate for an ordinary taxpayer. Therefore, it's possible for a taxpayer to make a mistake. Tax fraud is more than a mistake. It entails intentional wrongdoing. Therefore, a careless mistake or a good faith misunderstanding of the law by a taxpayer should not constitute tax fraud. Nevertheless, a taxpayer should be careful and accurate when dealing with taxes to avoid run-ins with the KRA. So what happens when a taxpayer is found guilty of tax fraud? Well, first, a taxpayer can be fined up to 10 million Kenya shillings or double the tax evaded. Secondly, it can result into jail time of not more than 10 years. In a case where a taxpayer omits or provides false information to any tax authority, he or she will be liable to 75% of the tax shortfall. As you can tell, all these penalties are highly punitive and geared towards preventing tax evasion.